great to have Adam here from Balance of Trade. I guess I speak for the rest of my group who love your articles, and welcome to the show, Adam. That article that you wrote, it seems like you got a huge response for that article. Why do you think you got such a huge response?
I think it was really controversial. To your point, when I say controversial, I'm not talking about the article. I'm talking about what Proshares did. And it was just a very difficult month for traders who traded in those products. Now, I understand that some people may have been on the right side of those trades and gotten lucky. Maybe you had a big position in XIV and you actually, I have a couple readers and followers who mentioned that they got out a few days before because things just didn't seem right, or they meaningfully reduced their position. But overall, I think it really spoke to the notion of when you are at the mercy of the sponsor, when you take a position in these products. And there is a difference between being invested in volatility via, say, like options, S&P options, which is what I tend to be far more involved with, or like VIX futures or VIX futures options, which I tend to not be involved with, but certainly keep an eye on, versus these products. And they did a lot of good for a lot of people. The right products, maybe not UVXY, for instance, but XIV did a lot of good for a lot of people. And I think it lured people in from the sidelines, and this looked like a magical trade and, et cetera. And I think people have to do some soul searching and figure out what it means. I think one of the biggest things that people need to understand was that the conditions that led to the huge run up are probably that was probably more of a fluke. Now, I'm not saying that Contango is a fluke. I'm not saying that you can't have a double or a triple in a short vol product. And I'm speaking of these as though like XIV still exists. I'm speaking of these as though like, SVXY wasn't re-leveraged, because that's its own can of worms. But I do think that it never should have been as much of a no-brainer as it was. That's what I'd really like to get at. It never should have been that much of a no-brainer. And hopefully now people, without having suffered too much damage, understand that they need to be paying a lot more careful attention to those kinds of issues. Like I said, these are really volatile products, and it was tempting to not rebalance because the drift term was so positive. And all else equal, if you have a strong positive or a strong negative drift term, you should be rebalancing less frequently. I don't think it's nearly as much of a given that you're going to get this beautiful, steep contango that's going to last for weeks on end with the occasional little hiccup here and there. I think that the VIX term structure is going to get a lot more whippy, and that there's going to be times when we're in contango, there's going to be times when we're in backwardation, and there's going to be times where it's pretty flat. But that structural aspect of return, in my view, was more of a fluke. And there are some really intelligent people that disagree with me on that point. I know, like Bill Valentine, for instance, and I don't want to stuff words in people's mouths. I don't want to, because I'm probably not stating his argument correctly. But Bill Valentine, for instance, I believe is a proponent of this notion that like the natural state of the VIX term structure is contango, maybe even steep contango. Again, apologies, Bill, if you're watching this and I'm misspeaking. But there are other people that have that view, and that's not my view. My view is that we've lived through a pretty short product cycle. These things haven't traded that long, and it just so happened that for the period that we did trade them, most of the time they traded in contango. And just for instance, like for the last decade, S&P futures have been in backwardation for the long part of that decade. But if you look back, 30, 40, 50 years, S&P futures spent plenty of time in contango, like maybe more than half the time in contango. And it just so happened that the last decade was one where we saw a lot of backwardation.
Well, it's, the futures of VIX products are obviously unique as compared with, say, oil or there's obviously a lot of education that needs to be done to the public and retail. I know that when Bitcoin came out, people were saying, "Oh, I'm going to trade Bitcoin futures because they'll be in Contango like the VIX is," and obviously people didn't sort of understand. When I was taught as a market maker about futures, I was basically just taught that the only difference, the only reason why there's most futures curves are gradually upsloping, and that's only just primarily due to cost of carry, for most of, like for NASDAQ futures or S&P or this sort of thing. And that, oil is a unique case because you've got the storage component, and then the VIX is, it's a different kind of risk, and so it's got a bigger contango. But like you very wisely point out, we don't have a whole lot of data here. We can sort of extrapolate a little bit, but like when I first became aware of the VIX was probably in 2002 or 2003, and it was just sort of an indicator at the time, just sort of an indicator.
Right, yes, an index.
And we're like, oh, wow, it's amazing how low the actual overall market vol is when we're trading stocks going into earnings with that are going to 200 vol and, 90 vol, 100. We're like, wow, the S&P really has a low vol when you put all the stocks together. And that was versus maybe, I don't know, 18 in the VIX or something. And so, they extrapolate a lot of data back, and, the kind of the rule of thumb that people will say, well, it's in Contango 80% of the time or something. And I think that is probably the majority opinion that it should be in Contango most of the time. But like you said, there's not that much data really to really, this huge move in February 5th is a prime example of how we don't understand what we thought we understand as much as we thought, because, we got this huge move. Doesn't seem like it was really driven by some current event or anything. And it makes everybody kind of rethink everything.
Yeah. And certainly I think there's also quite a bit of evidence. And SIBO itself, from an article that I saw on February 6th or 7th, had this sort of official view that the tail can't wag the dog, that, volatility is read off of S&P options, and then it goes over to a VIX index. And then from the VIX index, there are the VIX futures that trade sort of loosely, but in relation to the index. And then finally, at the very back, at the tail end, there are these, ETPs, these products like XIV, for instance. And it's a very linear sort of causal chain of the way that markets flow. And I understand that view. And like I said, from what I saw, it looked like SIBO itself espoused that view. And I think they've got some pretty bright people working there. But on the other hand, there are also some very intelligent people like Chris Cole that you mentioned. There's a quant guy who does some videos and presentations for Interactive Brokers. He spoke in October of 2017 on the potential for the tail to wag the dog, and so I tend to be more in that camp. That usually that chain is a good way of thinking about things until it's not, and when it's not, all hell can break loose. And absolutely, you can have a product like XIV or like UVXY upsetting the apple cart in a big way. I think that it's going to be an ongoing debate. It's not like, okay, well, now February 5th happened, and so this side wins. I think February 5th, because you mentioned specifically, there wasn't this macro event. There was no exogenous risk that came into the market. It felt very endogenous. It felt like the VIX itself was sort of puking up a position, and that it bled over. That's how I read it. That's how I see it. And I think that it's kind of a big point for the camp that believes that it's actually a two-way street.
Certainly.
I'm a big believer in debate. I think that it's great to hear what other people have to say and hear their reasons for what their view is. So.
Well, it's I interviewed a lot of people ahead of this February 5th, and my question to each person I interviewed was, can the tail wag the dog? And an answer I got from a lot of people was just, how do you notionally equate trading activity and S&P, the SPX puts to people buying and selling these products, and that translating into futures activity, and how what is to my mind, it just depends on how much volume it is on either side of that equation. There
Right.
obviously is a point where, like, if enough people buy SVXY, that the tail's going to wag the dog. But where is that point? When is it reached? And where's the balance lie? And how close were we to it moving into February 5th? And, an answer I was getting from someone like Vance Harwood was that he was interviewing futures market makers saying, well, we could do 3 times the capacity in these ETFs. But the thing is like, that's an answer like during like regular trading hours. That's not like when
exactly.
Everybody in the world needs to buy futures right this moment. It's a whole different game you're playing,
Absolutely. And like, it's very much the story of the lake that is on average 6 feet deep. But how deep it is right when you step in versus how deep it is in the middle. And liquidity, I think it's very easy to think of liquidity as like this ongoing pool that's more or less constant. And it's important to appreciate the fact that the liquidity story can be wildly different at any one moment in time. And I think we've seen it in the other direction at times where right after the French election, I want to say it was like April 23rd of 2017. I'm probably going to butcher the pronunciation, but Macron beat Le Pen, and in the weekend, the VIX got slammed lower. I mean, it just fell and very, very quickly. So it's not to say that can't happen in the other direction, but I would definitely think that if you have panic buying or panic selling of VIX futures, I'd probably err on the side that people are doing panic buying at any one of those crisis moments. So.
Yeah, I mean, I definitely a lot of my experience with trading VIX products has been trading in UVXY options, and I can tell you, if you're trying to get calls back that you're short when stuff is going crazy, the liquidity completely dries up in the options. There's nothing there. I mean, the markets are going to go $2 wide, and you're not going to be able to buy 100 on the offer even. I mean, they're just going to rip it even higher if you start trying to do any sort of volume there, which is just something you kind of have to be aware of with that particular product. But I'm a experienced market maker, and it's none of this stuff is shocking to me, and I know that that's going to happen at that time of period. So it's not the same dynamic as trying to explain to retail people what they should be doing. So I mean, I really feel a responsibility as somebody who is producing content to try to help educate people on this stuff, and that's one of the main reasons why it's so fascinating to have someone like you on who has really studied this stuff up. So yeah, Proshares delevered these products. Do you think is this the end of shorting vol as a effective strategy?
No, I don't think so. I think that shorting vol is going to become much more of a tactical strategy, much less of a strategic strategy. There was this notion that shorting vol was like the new buy and hold, and there were going to be times like August 2015 or January 2016. Or even like the immediate aftermath of Brexit, and you're going to take your lumps. But if you just take, 10% of your portfolio or 15% of your portfolio, and you just put it in a product like SVXY or XIV and just let it go, then amazing things are going to happen. And that really was true basically from February 2016 through February of 2018. That was true. And you could even extend out and say that was kind of true from the era that I suggested, like July of 2012. A fun fact, the very first, that quarter of 2011 that we had spoken about earlier with the debt ceiling.
Yeah.
XIV was down like 70% for the quarter. So there certainly were times where this product performed badly or ran into some major hiccups, but we just happened to go through a really calm period. And the takeaway of that is that I think people got way too comfortable with the notion of shorting vol is a strategic thing. Like grandma bought General Electric and held it for 40 years, and I'm going to hold XIV for 40 years. And it always, just because of its structural nature, it was probably something that was always more of a tactical play, when there are times that it's a good idea. And based on your own discipline, one person may look and say, yeah, I think it's a good time to own it. And another person may look and say, like that's what makes markets. But something that I think is true for everyone, not for a few people here or there, depending on their, what kinds of disciplines they follow. Shorting vol is a tactical play. It is not a strategic play.
Yeah, and that falls in the lines of what we were taught, in quote unquote market maker training school, which was that, you look at where volatility is historically, and it's going to have a range. And when things are in the middle of the range, then you're going to be small. If things are in one extreme or another, then you might take a bigger position on. But you're certainly just not going to. You're certainly just not going to have a volatility position one way or another. Just without being focused on exactly where it is in the range. Which is what these products allow people to do. Right.
And that's the thing is these products, and if you go and you look on the Proshares website, it basically says like, this is designed for, sophisticated investors with a short-term strategy. And I think on their website, they even have like sort of methodologies for thinking about rebalancing or whatnot. And so, yeah, I mean, they put the notices out there, but the question is, do people read them? Do people pay any attention to this stuff, or do they look at a price chart and they say like shorting this stuff is good or buying that stuff is bad? And then that's it, or buying this stuff is good. And then that's kind of the extent of the analysis. And I think that's where the trouble comes in.
Yeah. I mean, I certainly fall on the side of like, though it's not really these funds' fault if people didn't read their stuff. But at the same time, I'm an educator and I have to try to help get the word out on stuff like that. I
don't mean to interrupt you here, but
okay.
I don't think it's the fund's fault, but I do almost wonder if it's like FINRA's fault or the SEC's fault. It just feels like this was a big accident waiting to happen. It feels, if Wall Street is serious about people feeling, not having this kind of cynical view towards Wall Street, putting products out there that work really, really well until they blow up in front of everybody, blow up in people's face, doesn't seem like a good way to accomplish that like bigger goal of perception, or bigger social goal. I'm not saying that these products shouldn't exist, but it almost feels like you should have to be an accredited investor to trade them, or that you should, I'm just spitballing here, but like you should have to take some test or be able to answer some questions, or check a box that says, like, check a box and then check a box again and then check a box again. Yes, I read the prospectus. Yes, I read I went to the website of the sponsor. I don't think it's the sponsor's fault, but I can't walk away from this feeling like the industry did right by retail investors.
Yeah, it's been a PR nightmare for everybody involved, and I can't imagine that somebody like Credit Suisse or Proshares or Velocity Shares, if they could do it over again, I have to imagine they would do something different.
Yeah,
it's been a nightmare for them, I'm sure.
And even the groups that tried with the implementation, interactive brokers, they look like geniuses with what they did with the raising the margin limits, and they were crazy, the margin limits that they were putting on. Like back in September, October, we wrote articles about this, and
it was like 300% or something.
Yeah. And so, like in hindsight, they look great, but even then, it felt kind of draconian and not necessarily well explained. And they had some cool stuff. They had things on their website where this is what determines your margin. But a lot of investors and a lot of sophisticated traders who had some pretty serious coin in these markets just felt blindsided, and they felt like they could get they felt like they could get tackled or sacked right in the middle of a crisis with unreasonable increases on margins or whatnot. So I guess maybe on the one hand, things are a little too lax. But then on the other hand, it feels like we just need to have a really clear approach to what the ins and outs and the rules are going to be and the expectations and requirements. It still feels like maybe 20 years from now, we or people, others will kind of look back and say like, wow, that was the Wild West. It was like nobody knew the rules, and the rules were just changing all the time. And so it feels like we need to make some improvements there.
Yeah, well said. Well said. Well, I'm going to leave it on your final word on that, because that's definitely gives us something to think about, and you've definitely brought it to the forefront with your provocative and interesting articles, and we really appreciate it. And it's great to get to know you a little bit better. I'm sure my viewers will be happy to, because a lot of times, we don't really get to know the guy behind all these articles, and the comment section turns into a big battle between all these different opposing forces, and it's a wild thing. And I know a lot of people are upset right now, and it's a tough place to make content in right now, because people are on different camps, and a lot of people lost money, and it's hard. It's hard to see people who are following you, and people who you depend on for at least part of your income as a seeking alpha person. All these people are on divided camps, and a lot of people lost money, and it's a hard situation to be in. It seems like.
Yeah, and that's I like Seeking Alpha, and I'll close on my end with a plug for Seeking Alpha and a good note. I think that there's a lot of junk and people that are trolling and making dumb comments and like, oh, you lost money, well, you should have lost money. But I've seen a lot of really constructive discussion. I feel very privileged to have met some excellent people who are, at all levels, all experience levels. Some people that are basically just pure beginners, and others that have, they know their stuff. They've been doing this for a long time. And it's fun to see community. It's fun to see a sense of interaction. And for viewers of yours who maybe don't go on Seeking Alpha all that often, I'd say it's a really good place to go. Certainly, my articles, but anybody who's out writing good stuff about the volatility space and getting some great comments that and you want to read people and not immediately disagree with them. You want to read people who have a different opinion from you and really, really think about what it is that they have to say. And I think Seeking Alpha has been a really good forum for doing that. So
great points. And thank you so much for your time. Have a great rest of your. Much more time do you have in Vietnam now?
Vietnam, like for a little over a week, and then we go to Kuala Lumpur for almost 3 weeks, and then Bali for close to a month, and then back to Arizona.
Well, have a great rest of your trip, and on behalf of the community, thank you so much for all your articles. We really enjoy them, and you've definitely taught a lot of people about this quite confusing topic. So thank you very much.
Thanks. It's a real pleasure speaking with you, and I look forward to being more connected with you.
Great. Thanks. Yeah, let's definitely stay in touch.
Take care.
All right, take care. All right, so I'll stop it at that. Thanks so much for your time. I think we got some good discussion, and I learned something definitely. So hopefully other people will too.
Yeah, this was a lot of fun. It was great. And for instance, we didn't speak about the sort of the philosophy of the term structure. And I would love in 2 or 3 months or whatever to come back on and maybe we could have a fuller conversation about that, because I think it's a really important discussion. That's going to ultimately impact a lot of portfolios. So,
yeah, the term structure is really everything, and getting a handle on that is really what it's all about. Like Eli Mintz says, contango losses are forever, and I guess backwardation losses are forever too. As we
that's exactly right.
Yeah, and things weren't so rosy today as far as the term structure, but depending on which side you're on, I guess.
Right. Right. Yeah. And so, yeah, my view is that we're in a pretty whippy state. We can go back into contango very quickly, and that makes sense. We can shoot right back into backwardation, and that makes sense. And I just think that we've been programmed and conditioned to think of contango as normal and backwardation as abnormal. And it's just a question of sort of rewiring the way we think about that, those states of being. Because like you said, backwardation losses are forever too. And so, yeah, I'm here with my family, and we are in the town of Hoi An. And yeah, you should look it up sometime on Pinterest or whatnot. It's a really beautiful little town right outside of Da Nang. So
how long are you there for?
A little over 4 months. And our
Wow.
time is divided up. We're a month in Vietnam. We spent a month in Thailand. We were in Singapore. We're going over to Kuala Lumpur in Malaysia. And then we'll be in Bali for like 3 weeks. And then I go back to Arizona, or we all go back to Arizona in the middle of May. But we're travel junkies, and it's part of who we are. We homeschool our kids. My wife, Lindsay, and I, we have a 10-year-old daughter and a 12-year-old son. My wife actually has like a travel/philosophy blog. It's called dreeyourownweird.com.
For me, this is really inspiring.
And you can learn a little bit more about us as a family and, what we're into, that type of thing. I'd never been to Asia before, and it's a pretty cool place. I mean, we're really only in Southeast Asia, which Asia is obviously giant geographically, culturally, or whatnot. So we're just getting a sliver, but it's been really enjoyable so far.
Now, you were just mentioning to me before we went on the air here that you've taught a lot, and I did see that. I did check you out on LinkedIn and saw that you had taught graduate students about ETFs and ETPs, actually, which is pretty interesting. And I don't know very much about you. I just read your articles and thought they were really awesome, and wanted to have you on. But maybe you could just fill me in a little bit.
Yeah, sure. So we have lived in Phoenix since 2012. And I sort of divide my time between trading, now writing, and hopefully in the future consulting. And it certainly looks like we're heading in that direction, slower than I want, but we're heading in that direction. I teach finance, math, econ, basically where they need me. And so between trading and teaching and like I said, hopefully in the future consulting, that's kind of how we put food on the table.
So how long have you been involved with Seeking Alpha as a contributor there?
As a contributor, I think I wrote my first article under the handle Adam Zingg in 2014. And those were more like not at all volatility pieces or trading pieces. Those were more like big picture macro outlooks on the S&P 500. I did a series, Use Your Illusion 1, and it basically had to do with S&P sales growth. And it was like a 7-piece article on S&P sales growth. And I would say that certainly not like in the short term, but in the long term, I think that U.S. equities in particular are going to face some pretty huge headwinds. Now, I'm talking like 10 to 35 years from now. I don't have an opinion one way or the other over the next like 6 months or year. But I think there have been a lot of tailwinds, basically call it since 1982, that have spoiled investors. And eventually, at best, I think those tailwinds just kind of plateau. But I think it's actually quite a bit more likely that those tailwinds gradually turn into headwinds. And it's going to be a very different environment, in my view, than what investors have faced, like I said, since 1982.
Oh, wow.
So a lot of my initial articles were really on the investment side. And when I came into the business, it was more through, I read David Darst's Art of Asset Allocation, Mastering the Art of Asset Allocation, which are pretty meaty novels or tomes, whatever. I went in and got my CFA. I got my master's in financial engineering and applied economics, and did some consulting for like larger, big scale asset allocation, long-term investing, that type of thing. So really a lot of my initial attention in the industry was on that side. And I've obviously I spent time in Chicago working for a market making company, a prop trading firm. I trade options and futures on my own account. And I think that to some extent there's like a false dichotomy between trading and investing. At the end of the day, it all comes down to asset allocation. Maybe you're arguing about how quickly or how actively you're managing, but you're managing positions one way or the other. To my mind, investors spend more time focused on like the return aspect of things. And maybe that's appropriate, whereas traders just have to think so much more systematically about risk, and not just worrying about risk or thinking about it from a sort of a thematic standpoint, but like, what am I going to do if XYZ happens, is very much more in like the trader's toolkit. So long story short, I find both aspects of the capital markets really, really interesting. And sort of working to create some consulting products that are a blend of both worlds.
Well, it's interesting you talk about that because I'm sort of in the shadow of the fact that my family has been part of the sort of buy and hold investment thing, and has my father invested in his 401k all through his career and ended up making a ton of money off of it, and something that's been a huge boon for my family for many years. But at the same time, I was trained as a delta neutral options market maker, and sort of follow sort of that philosophy of like Tom Sosnoff and those guys from sort of the the more options market maker type philosophy, that like everything is based on probability, and that there's a 50-50 chance that something's going to go up or down, and that the rally that we've been on for so long is just sort of an anomaly, really. So it's it's quantitative versus like the buy and hold that our parents believed in, it seems like.
Right. And I think, we don't want to throw out babies with bathwater. I mean, there's reasons to believe, like over 100 years, for instance, that there should be significant edge, if you will, just baked into a buy and hold equity framework, or, buying stocks or bonds or whatnot, and going about your day, going about your life. And to a certain degree, I actually think that's a really healthy, good thing. I think society would be worse off if everybody was, looking at their position every 15 seconds. We would never get anything done. So I think that there's a place for that. My belief and concern is because so many investors have had an entire generation of, essentially low or falling interest rates, abating inflation, lower volatility, a more activist Fed, which have led to not only higher valuations, but actually higher profit margins. It has potentially created a sense of unrealistic expectations about how all this stuff plays out going forward.
Oh, I was completely out of the markets for about 10 years, and actually in the quote-unquote real world of United States society, where the average person thinks their way to wealth is through a scratch ticket. And trying to convince my coworkers that investing in a 401k or just saving $10 a week and putting it under your mattress, just getting the public to just start saving money. We're sort of in our little bubble of investors and people that are smart about the markets, but there's so much of the United States, if not the world, that just needs to be educated about the benefits of saving money and thinking farther ahead than next week or the week after, because the majority of people don't. I mean, at least around me in the United States here, and I don't know how it is. I don't know if you've been able to sort of take the temperature of how it is in Vietnam, but I suspect it's a little bit similar.
Actually, yeah, it's pretty different. I think people here are very entrepreneurial. I don't know, and certainly I'm on kind of like the tourist, the backpacker route, so I don't know what it's like in other parts of the country. But man, it feels like every, fifth house is literally a home business where the garage is open. They're selling treats or food or haircuts or, whatever, right out of their home. So they're really entrepreneurial here. And the sense I get is that they're investing personally and as a country in the future. Huge emphasis on the kids learning English. And it's funny because like the number one way that they're learning English here and elsewhere is just throwing the kids in front of Netflix for like 3 hours. Just watch Netflix, watch TV. And it's pretty amazing. Like 12-year-olds know slang and English and everything. It's fun to observe.
Well, I lived outside the United States for what at one point was more than half my life. And my father, being American and moving overseas, his way to learn Italian was actually in front of the television as well. I mean, even as a grown adult. So I guess, it's kind of that passive learning thing that, but it's so funny how Hollywood is sort of exported to the whole world. I kind of cringe to see what they must think of America. So do you?
Overall, I think it's pretty positive. Overall, yeah. I think it's got a good narrative. Certainly I can't say that universally. You watch Netflix, right? It's not all good. Overall, I think that it has been something that's kind of worked towards this notion of like shared culture. And it's amazing. And I, tell my kids, you can, on the one hand, you go to a Vietnam or you go to a Malaysia, and there are things that are uniquely Vietnamese and uniquely Malaysian, in a way that's kind of hard to understand as an American and easy to appreciate. On the other hand, it's like America is everywhere you go. We were in Europe for 4.5 months and, they're listening to songs that are put out by our entertainment industry it's just, there's definitely like America sets the pulse through the world and you're never that far from home in some sense. So, I think that that's kind of cool. I understand other people might not, look at it the same way, but I like it.
I mean, what an amazing gift you're giving to your kids. What an amazing experience for them to be able to see these different cultures in the world like they're getting to. How long is your trip going to go on for then? So you're in Vietnam now for a while. You were in Europe. How long's the total trip? Is it like a year?
So we started in the middle of July. We went out to New York City, and then we shot around Europe through the end of November. I have a good friend that I've known for 20 years who is from Northwest Spain. And his family has a farmhouse out in the country. So we did Thanksgiving with him and his family. It was our first Thanksgiving on a farmhouse or in a farm. And it was their first Thanksgiving period. So that was a great time. And then we went back to the U.S. to Arizona for Christmas. And we were home with family for like 5 weeks. And then we shot over to Southeast Asia. Like I said, we get back in the middle of May. And I mentioned that I teach classes. So I'm going to be teaching classes throughout the summer. I've already committed to teaching classes in the fall. And that puts me right basically to the middle of December. And I love teaching, and I hope that it's kind of always part of my life in some way, shape, or form. But I am trying to make the transition over to consulting. We're working on a couple of products, my friend and I, David, and David may become my business partner at some point. Just kind of has to work out for both of us. But in the meantime, he was a former student of mine. He was a former finance student, and just a really cool person. And he wanted to do some world traveling. We got along really well. He knows my family. And so he's traveling alongside of us. He's helping with, like getting FINRA paperwork, working with the website. And he and I are doing a lot of like R coding because we want to be able to expand out the scope and depth of the kinds of topics that we're covering in research and ultimately, consulting stuff that we'll be able to do. So.
Well, that's interesting. I interviewed recently this guy, Ilya, who's an expert in R coding, and he might be, I'll have to hook you up with him because he's an interesting guy as far as that goes. I'm clueless as far as coding goes, but I was asking him, we had a little discussion about Python versus R, and it was pretty interesting stuff.
Yeah, I'd like to see that. It is really amazing, and you realize, sort of Microsoft was built on Excel, 20 years ago, and Excel's a really powerful program. Obviously, if you spend any time in an MBA or grad school or just out in the work world, it's an indispensable thing to have Excel skills, for sure. But R is really more built specifically for processing statistical information, and then being able to visualize and display that. And it's really powerful and exciting. We're big R geeks at this point. It's just, whoa, did you just see what that can do? And it's
Right.
it's been a lot of fun. It's challenging too. Like you said, you're not a coder. David's more of a coder than I am. I have a little bit of a background in it, but it's been cool. And I mentioned that we homeschool our kids. So my 12-year-old, he's learning R. He's learning R coding, and for math, he's doing prob and stats and all that. So yeah, so it's fun to work on together.
So did you always have an interest in the markets and trading when you were a kid, or did you come to it a different way?
I wouldn't say that I had any kind of real interest until probably I was, 20, 21. I was a math major, and I went to Indiana University. There was a program called LAMP, Liberal Arts and Management Program. And basically, if you were a liberal arts student like I was as a math major, you could do something that was more than a business minor, but less than a business major. And so I did this program. And as I was getting ready to graduate college, my dad gave me, this was back in like 2001, he gave me the book Rich Dad, Poor Dad.
Yes,
and
great.
I really loved that book. Like, it resonated with me hugely. And I thought it was, in retrospect, it's a terrible finance book. It's a philosophy book.
Exactly.
And I think it's a good philosophy. I think it's an interesting philosophy. I'd recommend people read it. But I ended up staying in school for an extra year. I took like 53 credits in 1 year. And, extra accounting classes, extra finance classes, extra economics classes. And that's when I would say that I really got quite a bit more into the stock market and stocks. And then I met my wife. I'm like the only guy in the world that met his wife on spring break. I met my wife right at the end of college, and we fell in love like right away. We were married within 16 months of meeting.
Oh, wow.
And so I moved out to Phoenix. It was 2002. So the stock market was not doing very well in the summer of 2002. It was getting actually pretty close to its bottom. And we were in a kind of a mini recession, not a big recession. My original plan had been to go out to New York and try iBanking. But like I said, I met Lindsay. She lived out in Phoenix, and I think I made the right choice. We're going to have our 15th wedding anniversary here pretty soon. So we moved out. And Phoenix is definitely way more of a real estate, was and still is more of a real estate city than like a stock trading city or whatnot. And just with where the economy and where the stock market was, there really weren't a lot of jobs available for somebody newly graduated. So I did find something in real estate. So I became a real estate analyst for GMAC Commercial Mortgage. And cut my teeth with really applied corporate finance for analyzing, office buildings and medical office and retail and industrial warehouses and that sort of thing. So it really took about 10 years. That's a little bit over exaggerated, maybe 7 or 8 years before I found myself being able to actually be working with asset allocations and stocks and bonds. But it was always kind of like in the background, something I loved and something I cared about.
Well, you're right as far as like that period in the cycle was a really bad time for us at the SIBO. Definitely like 2000, 2001 when the market went sideways to down. Like all the order flow dried up and like no customers wanted to do anything. And so whatever position you had on, you were kind of stuck with. And it wasn't a fun time for us because stuff was going to decimalization then. There was these multi-listing wars, and everything was kind of going bad. And I actually have a friend who left the trading world and got into the exotic car business in Scottsdale at the same time.
Wow.
So yeah,
Okay.
they have, they have those big auctions out there. So
yeah, absolutely.
Barrett Jackson and
Right. Yeah, January, Barrett Jackson. Every year you get tons of people out there, and I'm not a car guy. For me, a car is point A to point B. If I have money to spend, I'm a pretty simple guy. I'm going to spend it on travel, or I'm going to spend it on food. So that's where my priorities tend to be.
Yeah, I agree with you. Yeah, a car is a depreciating asset, and as soon as you buy it, it just starts depreciating really quickly. So it's never a good investment unless you pick a specific one, I suppose.
Well, and I guess to me, it's like if you want to spend your money and you want to go to Las Vegas for a weekend, or somebody else wants to go out to a nice restaurant, or somebody else wants to buy a nice car. I mean, that's fine. That's totally fine. It's just tends to not be how I prioritize my consumption dollars, if you will.
So, how did you end up getting from that to studying ETFs and rebalancing ETFs? How did that become an interest of yours?
Yeah, well, within the asset allocation framework, I mentioned David Darst in the two books, The Art of Asset Allocation and Mastering the Art of Asset Allocation. And, I became kind of a disciple of that mentality that you can pick individual stocks, that there may be a place for that. But what you really want to be doing is kind of looking at your portfolio from 30,000 feet. And thinking about things like strategic allocation. What are my needs for the next 10 years or 20 years? What kind of cash necessities do I have coming up? And trying to come up with a notion of a longer term view of markets. What's my view of the stock market 10 years out? So a strategic allocation, then a tactical allocation. Trying to get some better sense of which portions of your portfolio you'd like to overweight and underweight relative to your strategic allocation. And then finally, what do I have right now? What's my current allocation? And how do I want to go about, sort of getting more in tune with what my tactical allocation is, but not like sort of blowing up with a ton of trades, making lots and lots of trades, because if you're an investor or you're an asset allocator, I think you want to sort of keep trading to a minimum within that particular context. So to do that, I needed to come up with ways of really I wasn't going to be telling people buy Ford or sell Nike or whatnot, and so it was going to be more of a passive strategy. Now, passive might mean mutual funds. Which has sort of become like a dirty word over the last, 5 or 6 years, just because of how active management has been, sort of trounced by the low cost ETFs. But at the same time, whether it be mutual funds or whether it be ETFs, having some systematic way of analyzing them and understanding what's going on for just really simple stuff like, reading the prospectus. But in a lot of cases, I called up the fund manager. In one case, I got to actually speak with the manager of the fund, which was pretty fun. It was Luz Padilla, who works alongside Jeff Gundlach, and it was the Emerging Markets Bond Fund. So but looking and where and when do you expect these ETFs to perform well? And where and when would you expect them to sort of underperform their benchmarks or reasonable expectations or what have you?
Wow, that's fascinating stuff. Yeah. I recently was watching this thing about how 401ks came to be and how they came to be paired with mutual funds and how it was a great fit for both parties in a way, and the Peter Lynch and the whole advent of the mutual fund era. And now that, like you said, you've been right on the trend of us getting into much more passive investing. That's been the trend as of late, certainly. And but in a sense, in my mind, mutual funds, like a mutual fund and a passive and an ETF, there's not that much difference. There's some fees different, but in the end, there's some more similarities than differences in my mind. Once again, I sort of go back to this thing of like the vast majority of the people that I know and are friends in my life don't do any sort of investment at all. And so if I can convince them to do any sort of investment and to get them into some sort of broad-based index or any sort of fund like that, then and get them to save anything at all, then that's a huge victory for me. And to me, as far as like numbers of people, but I'm really interested when I hear someone like you talking about this stuff, because I never went to grad school or studied portfolio management, so it's all very fascinating to me.
Yeah, so the study that you were mentioning, I led a team of grad students. There was one PhD student, and basically what we started doing is looking at rebalancing strategies for individual funds. And for the most part, I want to say this was going back to like 2010. So for the most part, they were mutual funds, but some of them had really high returns and a lot of volatility. Some of them had negative returns. Some of them had really low volatility. And basically what we examined is what was the overall impact on risk and return by sort of reallocating or rebalancing a portfolio. And what if you do that every 6 months versus what if you do that every year? Or what happens if you do it like on targets? Like, for instance, if the asset goes up by 15%, then I'm going to rebalance. Or if it goes down by 30%, then I'm going to rebalance. So trying to answer those questions. And, what I walked away with is just the impact of volatility on investing, and having some kind of a plan in place. And certainly returns matter. Of course they matter. And I'm talking about returns at the individual stock or individual holding level. But it's funny. I mean, you met me on Seeking Alpha, and if you go on Seeking Alpha, certainly return is one aspect or element of the alpha equation. But risk is like the other side of the coin, and there's very little in the way of like systematically thinking about risk, in my opinion. It's kind of like yada, yada, yada. This is a great company. This is a great fund. And then like, boom, here's a little paragraph on risk. I think that's really kind of putting the cart before the horse, in my opinion.
Well, one of my friends, FLE, who I've had on a couple of times, is a hedge fund manager, and he talks to me about how allocating based on the volatility of a different asset class, weighting stuff based on volatility. So, for example, in his portfolio, if he's got something that's very low volatility, then he's going to allocate a lot more to that asset. Otherwise, it's going to be overshadowed by the volatility of the more volatile assets in his portfolio. And I was also checking out some of the stuff by Chris Cole from Artemis Funds, where they talk about systemic risks of all these funds that base, that do have sort of rules in their portfolio based on volatility movements, and how like a big move in volatility can make those guys adjust and sort of have things snowball. Right.
Yeah. So like essentially those are all variations of a risk parity strategy. As I understand it, I'm not an expert on, risk parity. But as I understand it, it effectively amounts to negative gamma, that you sort of buy into low vol and you buy into low vol tends to correspond with strength, and you sell into high vol, which essentially means selling into weakness. And it's been a pretty good strategy, a pretty good formula over the last 5 or 6 years. To my mind, there's actually a really big difference in the markets, the trajectory that they've taken since like July of 2012. July of 2012 is when Draghi sort of uttered the famous whatever it takes speech. And, the recovery or the expansion or bull market or whatever has been going on since March of 2009. But again, to my philosophy or my way of looking at it, there's actually some really big differences between, sort of mid 2012 prior, where if you think back to say 2011, July, August, September, October 2011, you had the VIX up at 50, and the entire term structure was essentially flat in like the 45 region. And it didn't just go there for a day and then drop back down. Like, it stayed up there for a while.
There was like 60 days or something. Yeah.
Yeah. You look, and like the Russell 2000 lost 35% of its value in 3 weeks. And the S&P like just sort of barely stayed out of bear market correction territory, or bear market territory. I think it bottomed like October 3rd or whatnot. But again, to my way of thinking, and it sort of looked like we were going back there, just to refresh viewers' memory. The whole Greek debt fiasco was coming back to the fore in May, June of 2012. We had sort of gotten around the whole debt ceiling debate. Of course, we still had the fiscal cliff. Does anyone remember how many times we heard fiscal cliff in 2012? It's funny how that stuff,
I remember all that stuff. Yeah, the European bonds and all that stuff too. Yeah, that was.
Yeah. But there was a huge sort of turning point in the narrative once Draghi got on with the whatever it takes. I think markets took him very seriously, very early. You went in, and in September of 2012, Ben Bernanke announced his QE3. Depending on how you like to think about these things, December 2012, he announced his QE4. And you got Abenomics in, Shinzo Abe won the Japanese elections in like October, November 2012. And he had the three arrows, and the first arrow being, very generous, accommodative, one might say aggressive monetary policy. We're actually still waiting on those last two arrows. I don't know, the fiscal reform and structural reform. But and I bring all that stuff up, A, because it's kind of fun to talk market history and whatnot. But B, it feels right now like the markets are in a state of flux. In 2017, a lot of people like to say like climbing the wall of worry, markets climb the wall of worry. My view is in 2017, they did not climb the wall of worry because markets just weren't worried. And it wasn't like isolated to U.S. equities. That was true in treasuries. That was true in, gold. That was true in emerging markets and whatnot. And not only on the return aspect, but what I'm specifically referring to is in the vol space. You had like the lowest implied vols pretty much globally. And so nobody was worried about anything. Now enter into 2018, and that has definitely changed. We had the big, VIX explosion on February 5th. And to me, it just feels like we're trying to figure out where we are in this narrative. Does the mid 2012 through end of 2017 playbook, is that the playbook that we're supposed to be following? And I think that there's like a reasonable amount of evidence that's still in force, that's still in play, especially because I think people get a little bit too keyed up about how well the economy's doing. But at the same time, it is definitely better than it was, say, in mid 2015 or early 2016. To my mind, you can't really argue that point. And so where is the economy? Where are earnings? How are they doing? And then just like, what is this larger appetite towards risk? But it does feel like going forward, if stocks are going to climb or risk assets are going to climb, they actually really do have to climb a wall of worry. And that's the larger point that I'd like to make.
Well, I know you're far away from the U.S., but you're not too far away to realize that there's a certain section of the American public that's ultra focused on politics, it seems like, and sees everything through the lens of just American politics and what's happening. And that's obviously separated from the markets, but you wouldn't know it to hear a lot of people.
Less so. It feels like 2018, the whole, trade tariff policy and whatnot really has sort of rocked markets, even when they've recovered, even when there's like the buy the dip, the Gary Cohn resignation. The market fell like, I don't know, S&P fell 40 points in 15 minutes or so. Now, it recovered all of that by the end of the trading day. And that gets back to my point that it's not to say that they can't climb the wall of worry. But it seems as though you go to 2016 and you have Brexit, and the market has shrugged off Brexit in like 3 days. Or, Donald Trump gets elected, and while he's getting elected, S&P futures are hitting limit down. And by the market open the next day, the market is opening basically flat or even a little bit positive and closing positive, where these sort of political curveballs were completely and immediately discounted. Whereas now it just doesn't seem like there's quite as much wiggle room, quite as much grace.
I mean, to me, what's happening now seems like more normal in a way.
Yeah, for sure. I mean, lest we forget, the VIX is essentially trading at its long-term average.
Yeah, definitely. Yeah, I wanted to, if you could just explain to me a little bit more about what you were talking about with rebalancing. We were talking a little bit about what you've learned about rebalancing a portfolio. You were kind of talking about how somebody has an overall portfolio, and how do you rebalance it, or how do you when you're slightly changing strategy, how do you go about doing that in the right way? Can you explain, like, sort of simply some of your ideas on that?
Yeah. So as far as rebalancing, as it turns out, there's the number one sort of component to how often should you consider rebalancing has to do with the volatility of the underlying asset. One would think that it might have to do more with the return, and sure, there is an element of that. If you get an asset that's got a huge positive return, like a big upward drift, then maybe rebalancing a little less often can be good. If you have something with a huge downward drift, then maybe a little less rebalancing can be good. But where things really come into play is the volatility. The higher the volatility, the more you want to be sort of taking chips off the table when things are going well, and adding more to the position when they're not. Of course, that means that you have to be thinking pretty carefully about what volatility is. There's a good correlation between volatility and negative returns. In other words, like, just for instance, when the stock market goes down, the VIX tends to spike. And people, you need to be careful to understand that that's not what volatility is. Like, that volatility is essentially a math equation, and it's the average distance from the average. And the average what? Well, the average return. And that return itself can be positive or negative. And distances, volatilities by their structure, just the way that they're mathematically built, are a symmetric concept. So, of course, you can get into skew of a distribution. You can get into kurtosis of a distribution, which is still a symmetrical concept. But here's what I'm getting at. Without going too deep into the weeds, rebalancing is definitely dependent on, to a degree, the drift term of the underlying asset. The bigger the magnitude of the drift term, the less you want to rebalance. But it has more to do with the volatility of the asset. And the higher the volatility, the more you want to rebalance. but we need to be very careful of what we mean by volatility. We mean it in a very precise technical sense, not an intuitive sense.
So just to sort of give an example, what sort of what would be like sort of an example portfolio that somebody might have? Would it be a mixture of like stocks and bonds or that sort of thing?
I think that there is focus and capacity to create other kinds of portfolios. And I think there can be a case for that, just depending, again, it comes down to your strategic allocation and your philosophy and your view. That's definitely, something that can be put on the table. I think a lot of it comes down to maturity. And a lot of it comes down to a client's need to hew closely to a benchmark. If somebody's managing their own money and they just don't give a rip what the market does, good, bad, or indifferent, then I think there's a case to be made that you can sort of stray from a 60-40 portfolio or some variant thereof. If you're a manager or somebody that needs to follow a benchmark, then obviously you just have a lot less flexibility. And the other thing is some people are just never happy, and I don't mean that, I kind of mean that as a criticism, but when markets are going down, they're freaking out. And when markets are going up, they're, how's the market doing? How am I doing? How's the market doing? Am I trailing? Am I ahead? And I think going in, you just need to have a mature viewpoint. And if you have a mature viewpoint and the ability to be independent, then certainly you can be more flexible.
Yeah, it's about, I guess, managing customer expectations, of course. It's like sort of educating people about sort of what to expect. And I guess finding out people's tolerance for risk versus how many years they have, how old are they, and that sort of thing.
And of course, ex ante risk is never the same as ex post risk. So the amount of risk people say that they're willing to take is not the same as how much they're actually willing to take. So after the fact. So you see people that, hey, market's going up. I want to be more in. Why aren't I more in? And then the market falls 3% or 4%. And it's like they want to pull everything out. At that point, you really don't understand what it means to take risk. Like, you truly are taking risk when you put your money in capital markets. And there's a good side to that. And of course, there's an uglier side to that also.
I mean, that's why I always wanted to be a trader, is because I didn't want to have customers as much. Now, as an older adult, I've realized that you always have a customer somewhere. Somebody's always your customer. But
right.
But I was always, initially I worked for a stockbroker and had to get leads and get customers, and I wanted to be the guy that was making the decisions, not the guy who was collecting people's money and stuff like that. And
right.
But I'm definitely being exposed more through some of these interviews to the what it's like managing other people's money and how you relate to your customer, which is like you said, ultimately incredibly important. What they want out of it, and what explain to them what you can offer to them out of it. Yeah. I do want to get to your article. And to some of this VIX stuff, but I just wanted to ask you about Seeking Alpha for a second. I've known some other contributors as well. How tightly do they sort of editorialize your articles? Do they put constraints on you in a certain way, or how did you become a contributor, and how does that process work?
They're tougher on you at the beginning than they are at the end. Like, I just published my 300th article. Oh, wow. And most of the time, most of them are market volatility bulletins. They're pretty templated. There was quite a bit of back and forth, probably the first 10 market volatility bulletins, what we could say, what we couldn't say. At the time, I had a partner, Phil, who was a full-time day trader. And when we originally envisioned the market volatility bulletin, there was a very large focus that was going to be set on on trading. Can you hold on for a second?
Yeah,
There's
sure.
a door, a window just opening and closing. I'll be right back.
Yeah, no problem.
Yeah. Cool. Sorry about that.
No worries.
So yeah, the first several articles, there was quite a bit more in terms of back and forth. I spoke with Mike Taylor, who's the head editor. I spoke with George Moriarty, who's the sort of the head of content. And we spent some time talking about how to craft it. As I was mentioning before, my ex-partner, Phil, he was a full-time and is a full-time day trader. And so the original market volatility bulletins had an educational focus and were going to be more about writing with, like how Phil would look at a trade, how Phil would set up a trade. And basically Seeking Alpha said right away, you can't do that. We're not going to let you do that. And so, it's their forum. We had to play by their rules. And we worked with, with a template that did work. And since then, really the first 6 months were about, the markets open at 6:30 in the morning, usually in Phoenix. So the first 6 months was about waking up super early in the morning and getting content out there in a pretty templated fashion. And can you wake up at 4:30 or 5 a.m. every morning and just do that day after day after day? And we just wanted to see, he and I wanted to see if that was something that we could do, that is there a future in that? And the answer, turned out to be yes. Phil did ultimately just decide he didn't want to do it anymore. There was the whole business consulting stuff. I had taken over the content and the writing. And as mentioned, he had wanted to get in right away with doing, videos, and getting in with the day trading futures. And it was just a longer road to that, I think, than what he had planned. So he ultimately backed out. He's a great guy. I'm still friends with him. It did, frankly, leave me in a little bit of a lurch because I had already planned to leave the country with my family and focus more on writing. So he was going to do the back end stuff of the website and, the FINRA and putting together videos and all that, while I was going to work more on content. I did work on content. I wrote a lot, met a lot of really great people, developed something of an avid follower base. Depends day to day or article to article. But it became clear to me that I couldn't just write articles. If I was going to burn myself out. And at the end of the day, there wasn't going to be, it's for Seeking Alpha. You might make $1,500 a month writing articles, and certainly, that actually goes further in Vietnam. 1,500 goes further in Vietnam than it does in Phoenix. But it's not something that people aspire to, or at least I don't think they should. And so we had to rethink. My friend David, I reached out to him. He was traveling as it was. And that's where I mentioned right now more of the focus is trying to develop the business. Just because I'm in the habit of writing market volatility bulletins, I still write them. And I, plan to continue to do that. That'll likely always be a part of what it is that Balance of Trade is about. But really, I'm mentioned really working with R. And trying to get back to my old roots, which my old roots were looking at things within a bigger context, looking within the context of an asset allocation. And I'm hoping to ultimately be able to, and I think we will be able to, marry the trader camp with the investor camp. And mostly what can investors learn from traders? I think maybe traders can learn some things from investors. And I think that traders should definitely invest and save for the future. And that should look different from trading because of things that just happened with XIB. I mean, if you were trading and you had a 1,000% gain compounded into 100% loss is 100% loss. And I do think that trading is more of a job, whereas investing is more about saving up for your future and retirement. And so, yeah, I think traders can learn from investors, but I think investors can really learn a lot from traders. And that's kind of the direction I see Balance of Trade going, say, over the next, 3 to 6 months.